Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. No matter how you slice it, any ETF with the name artificial intelligence is outperforming this year. It doesn't matter whether it's index-based or actively managed. Doesn't matter if it's market cap weighted or equal weighted. S&P is up 19% year to date. 4 ETFs that invest in artificial intelligence themes are up anywhere from 30 to 46%, about twice as much. But there is enough for investors to invest in. But are there enough stocks? Let's talk with Rich Lee. He's the head of program trading and ETF trading and execution strategy with Baird. Todd Rosenbluth, my old friend, is the head of research at VettaFi. Rich, these AI ETFs have a lot of familiar names in them. The Global X Artificial Intelligence Technology ETF, the AIQ, that's probably the most well-known. We have NVIDIA in it. We have Meta in it. We have Tesla in it. We have Microsoft. We know all of these names, but there are attempts to get broader coverage out there. What else is available in ETF land other than just buying something that's got, Microsoft and Tesla in it, for example?
Sure. Thanks for having me, Bob. A couple of things with that. With regard to AIQ, WTAI, and iRobo, right? AIQ is a market cap weighted ETF. iRobo and WTI is equal weighted, right? So you're going to get diversification from having something that's either market cap weighted, right, which is going to tend towards the larger companies that are out there, or equal cap weighted, which is going to give you broad exposure. With regard to broad exposure, these ETFs have somewhere in excess of 85 to 155 names. On top of that, a lot of these names have global exposure. So in addition to names like ServiceNow in the US, you're looking at names like Fanuc in Japan. So there is global exposure to it as well. So it's not just the names we commonly associate with AI.
Right. So that's a very important distinction. Those that are set to an index that are market cap weighted, and there you get that heavy, you get the Microsoft and NVIDIAs of the world. But there's ways to look at it on a broader level, Todd, where you get more equal-weighted ETFs that don't. So here's the problem I have for ETF investors in general. We've talked about this for years, you and I, other hot topics in the past, cannabis and crypto. The current choices are narrower than most investors believe. And now I see some arguing that the AI revolution should be broadening out, and investors are going to have a lot wider choices. I mean, what else was out there? He mentioned, I've heard all sorts of unusual things besides Salesforce that are out there, Broadcom and other names.
So from an ETF perspective, we're certainly seeing it. At VettaFi, we actually track where people visit on our website. And in the last 4 months, we've seen consistent flows and trends towards robotics and AI ETFs using our Explorer data. So it's those ETFs that Rich was talking about, but it's also ETFs like Robo, which is a Robo ETF that's tied to a VettaFi index. It's BOTZ, B-O-T-Z. Which is tied to a Global X product. It's IRBO, which is an iShares ETF. They're using artificial intelligence and robotics. And so AI is going to empower the industrial space and robotics to make them work and become more efficient. We're seeing trends towards healthcare, where Intuitive Surgical is a company that's benefiting from artificial intelligence. We're seeing eBay, e-commerce companies, the more that they know
now,
about...
How does eBay benefit? I guess in the sense that you can use AI to more efficiently run the whole process, the website itself.
Right. So to know more about the consumer trends and then position products based on it to become, again, more efficient. So AI is, you can invest in companies that are directly targeted to it and that are indirectly benefiting from it. And those are some of the trends that we're seeing.
So maybe another way to play this, instead of, we've had companies, for example, ETFs that have 100 names in them that are equal weight, but maybe take the Cathie Wood approach. More concentration is the answer here. So I'll give you an example of this, folks. Roundhill has a new AI ETF, CHAT, C-H-A-T. This is an actively managed fund that only invests in 25 to 50 companies. It's a little more concentrated than some of these other ETFs. It's global, involved in generative artificial intelligence and other related technologies. So there's some example here. Again, this is actively managed. This is not tied to an index. So there are my point here is there are different ways to play this. You're not just stuck with Microsoft and NVIDIA necessarily. Here's a company that actively manages, tries to pick stuff.
Yeah. I mean, you mentioned ARC, so they obviously have been tied to this as a broader disruptive technology theme. We've seen Harbor have a disruptive technology. Goldman Sachs has a disruptive technology ETF. And these active managers are increasingly turning towards companies that can benefit from artificial intelligence or that are investing in it. And they have the ability to swing in certain directions based on what trend is in favor and what trend is out of favor. So I think we're going to see more of that as active managers in the ETF space move into this world.
So the viewer is probably sitting there saying, my head's spinning. I don't know what to do here. I might want to do something in AI, but which one do I pick? And what's interesting is it didn't matter this year. Any of the, I mentioned four, I just picked four of the biggest ones that are out there, AI ETFs. They're all outperforming right across the board, the average market. 30 to 46% gains versus 19 for the S&P 500. So in a sense, being there was important. In fact, just owning the S&P would have mattered this year as an AI play at this point. So this is why I tell people, they ask me all the time, what should I do? Don't panic too much and don't get too clever. If you really want to exhaust yourself, there are lots of ways to play this. I showed you. We just talked about it. But just owning the S&P 500, you would have been a beneficiary this year.
Or the triple Qs has exposure to obviously these mega cap growth companies as well that's benefiting, or QQQM, which is a lower cost version of it. AI has been driving the broader marketplace this year. Now, will it continue to do so in the second half of the year, and can these companies continue to become profitable as a result of these drivers? Those are the things I think many viewers are thinking about.
Yeah. Rich, the AI revolution, and I constantly keep trying to broaden this topic out beyond Microsoft. There are more than just tech companies involved here. An old friend of mine, Julian Emanuel at Evercore ISI, was out with a note recently saying even large industrial names can be beneficiaries. And the trick here, it would look at something, a subspace like industrial automation. So, for example, Ingersoll Rand and Eaton are two companies that are very involved in industrial automation. They have been outperforming the industrial space this year, I think partly on the idea that industrial automation would be a big beneficiary of artificial intelligence. There's Ingersoll Rand. Look at that. That stock's been up, ever since this whole discussion on AI has been going on for the last 6 months. And the same with Eaton as well. So there are other ways to look at this.
Sure, absolutely. If you're familiar with Amara's Law, right? Amara's Law basically says that humans tend to overestimate the impact of technology in the short run and underestimate it in the long run. So they overestimate in the short run, underestimate in the long run, right? And so we're just in the sort of early innings of this, right? And if you think about industries where you may not traditionally associate with AI or tech, you think about industrial. So Ingersoll Rand, which is poised to capitalize on reshoring trends, automation, operational efficiency. Same thing with Eaton, which are looking to look for automation and better processing through automation. They're going to have to look at things like AI as part of their business processes to realize some of these gains. So we're going to start to see AI creep into other sectors and industries we may not traditionally associate with tech or with AI.
See, this is what makes me excited about this a little bit, because you and I, Todd, have talked about the revenue problem. Like, right. Okay, fine. How much of we say Microsoft is an AI play, but how much of Microsoft's revenues are really coming from AI? Well, it's more, and other companies may be a lot smaller. But if you can say, well, AI is going to be used in Ingersoll Rand and Eaton to improve the product and line. Well, that's kind of hard. That's not necessarily a revenue play. That's just a productivity improvement play. That could even be a margin improvement play. Right. On the bottom line. Harder to measure. We always say, oh, they're not important. It's only, X small percentage of their revenues are generated from whatever, crypto, cannabis, or, now artificial intelligence.
And that's the way that ETFs that are exposed to AI think about it, is from a revenue standpoint. So the research-driven approaches that Global X uses, or Robo uses, or iShares uses to support those indexes is looking at companies from a revenue standpoint. But yes, AI is going to improve the profitability of so many of these sectors. Agriculture, for example, consumers, you mentioned industrials. And so it's going to have a broader impact on the overall economy. It isn't just going to impact the technology stocks that are going to be beneficiaries of this trend.
Yeah. So what else do you, if you believe that, then almost anything is potentially rife. I mean, software as a service, 10 or 15 years ago, revolutionized back office stuff, because all of a sudden a lot of stuff that was difficult became a lot easier because of software as a service. Stuff that was redundant, that we didn't need as many people. And we've lost some jobs as a result of that, and yet nobody sits there and cries about it. Everybody says we're more efficient.
Well, even the financial technology space in general is going to be driven in part because of AI. It's going to help advisors do their jobs better. It's going to help investors sort through the information better. It's going to process things. It's actually, we have fintech as one of the areas that we're focusing on at Verify. We have an AI symposium that's going to take place August 30th, and fintech as well as robotics and traditional AI are three of the themes that we're going to be exploring.
And you work with Verify, those who don't know, work with RIAs, registered investment advisors, and what they must be very interested in ways to use AI, not to pick stocks so much, or maybe, but more to help them run their businesses better, right?
Yes, and I think advisors are trying to become more efficient, free up their time, to free up some of those back office capabilities so they can work more closely with clients, either in picking stocks or helping them plan out their goals. And so AI is certainly top of mind for those advisors.
I don't want to spend my time doing accounting or hiring a team to manage the back office. I'd rather spend my time talking to clients and helping them out, generating value for the clients, right?
Absolutely. And I think about ways AI are going to be so accretive to the industry. You think about, for us on the sell side, right? Data processing, differentiation of content, that's going to be a huge area to explore within the industry. And just like e-commerce, kind of going back to 1.0, I think people overestimated initially and underestimated the impact it had over the long run. And I think we're going to see the same thing play out with AI and the productivity gains we're going to see.